Another 0.5% came off of the official cash rate last week. The OCR is now down to 4.25%, and many people would speculate that there's another 0.25% coming off in February and another 0.25% at least coming off thereafter. Homeowners and businesses are well overdue some relief here, but for many it's going to be too late. And this is yet another sign and symptom of an imperfect financial system. Half the people out there feel like the interest rates should have been cut deeper, and the other half fear a resurgence in inflation. I'm worried about stagflation, where we get the worst out of both worlds. So today I'm bringing a discussion to you with Chief Economist at BNZ, Mike Jones. Today I'm catching up with Mike Jones, Chief Economist with BNZ. How are you, Mike?
Hey, Darcy. I'm very well. How are you?
Very good. Very good. I'm going to start just with there's a graph that there's a couple of graphs that have stuck in my head over the past few weeks, and one of them paints a pretty dismal picture of New Zealand's labor market. And on one side of it, it talks about the number of job ads, which have plummeted down to levels probably not seen since 2011, if I'm reading this correctly. And the job applications per ad has spiked to a level that it's off the chart, literally. Like, it hasn't actually ever gone this high before. So starting with this jobs ad report that came out recently, what does this say about the current state of New Zealand's labor market? It's kind of obvious, but what is it saying right now?
The message from both of those series, as you've described, is relatively clear, which is that firms are not hiring. If anything, firms are looking to sort of row back on their staffing requirements a little bit. And at the same time, you've got a bunch of people out there looking for work or looking for extra work. So the labour market is quite clearly oversupplied. That's why you're seeing record numbers of job applications per ad out there at the moment. So we've had really strong population growth in the last couple of years, and we're now seeing employment come down, or employment growth slow down. So it's a recipe for unemployment to keep rising, we think, and all of the things that go with that as well, whether it's falling wage growth, kind of fewer job opportunities, fewer poaching. It's essentially the complete flip side of where we were 2 years ago when we had a record tight labour market.
And what does it say about during times of tough economic conditions? Often some people will leave New Zealand and go overseas to get work. And I'm just wondering, I'm curious whether or not we're losing the right skill set and we're retaining the wrong skill set, which might set us up for failure when things do rebound.
Look, there is a large element of cyclicality in all of that. You tend to see New Zealand citizens leave when the jobs market in Australia in particular is stronger than it is here. And you can line up kind of the difference between those two unemployment rates and the number of people leaving pretty closely. So it is cyclical in that sense. So we would hope to see those people back when the New Zealand labour market rights itself, right? So, we don't know at this stage the extent to which we will see those people back again, kind of hoping that we do, and that helps us with our productivity challenges and all that sort of stuff that you might have been getting at.
Yeah, and I guess just from a business owner's perspective, I know for myself in the past, sometimes the main barrier to growth is finding the right skill set of people to help you grow your business. And yes, I guess there's a feedback loop here going on where it's not just a matter of waiting for the job openings to magically appear. There actually has to be business done and business growing to create those new job opportunities. But if there's not enough skilled labor to fill those needs, businesses can't scale. And therefore, you kind of get this vicious circle going on, right?
Yeah, that's right. I mean, regardless, I suppose, of the cyclical state of the labour market, there's always going to be this challenge of matching skills to the sorts of jobs we want to create. And I think, look, that's probably part of the reason the labour market perhaps hasn't weakened off as much or has been slower to weaken than we might have expected, because firms really had to battle for a while there to get the workers that they needed. That's right. So they've been pretty reluctant to sort of change that mix, because skill shortages have been and were a real challenge for a long period of time. So I think firms have and are continuing to do everything they can to kind of keep that front of mind, even as we go through the recession in this weak labour market that we are, because it's often hard to attract people back when you need them.
Yeah. Okay, so let's talk about interest rates for a second. This is a massively complex topic, so we're only going to really be able to scratch the surface in a couple of areas here. But as it relates to where interest rates are at here in New Zealand, the official cash rate, there's an announcement happening like in a few hours. And
I hope we get it right.
we hope we get it right. That's right. Well, what is right? Like, in your view, what would be a right answer? 50 points off?
Yeah, I mean, that's our core view. It's probably also what we think should happen. And those two are not always aligned. We would probably say, though, and we have said, there are three possible outcomes in play, which is a little bit unusual. I mean, you've seen speculation still, even with a few hours to go before the meeting, that the Reserve Bank could cut by a larger amount, 75, or there's some even saying, well, maybe even just 25. That we're getting a cut seems pretty likely, but the exact number is still up for debate, albeit the consensus is certainly 50. I can understand the logic for all of those three outcomes, actually, but probably 50 is the sort of Goldilocks just right amount if we want to get really cute and clever about it from where we sit today.
Yes. We started this cutting cycle, I think it was in August 2024, after massive increase in interest rates, relatively speaking. They stayed there for a while. Really, the objective was to bring damage to the economy to flush out inflation. And definitely in terms of the first part of that initiative by the Reserve Bank, they have definitely brought the New Zealand economy to its knees, in my view, from where I sit, as well as what I'm hearing anecdotally everywhere, that there's a lot of pain out there. There's a lot of businesses suffering right now and a lot of tough decisions being made. And so they've definitely been successful in that second part. But as it relates to the first part, but as it relates to the second part, actually stamping out or flushing out the inflation, would you say that it is appropriate to say that the momentum is picked up around the victory dance with inflation? Like it is an almost absolute certainty that inflation has been dealt with?
I don't think you can ever rule out inflation for the foreseeable future and just say, look, it's dead and buried. From where we stand today, it looks like the inflation challenge, the high inflation period of the last couple of years, is done. It's behind us. Inflation's at 2.2. It's close enough to the middle of the Reserve Bank's target range. We can't see anything in the next wee while that's going to threaten high inflation or rapidly rising inflation anytime soon. In fact, if anything, the risk from some of the short-term indicators we're seeing, and indeed the weakness in the economy you mentioned, is that inflation might go below that target midpoint of 2%. In fact, that's in our forecast, that by the end of next year, we'll have inflation with a 1 in front of it. Late ones, but still 1. So as far as the Reserve Bank policy and interest rates are concerned, yeah, I think we can put the inflation challenge behind us and concentrate more on, the economy, basically. Can we try and now bring this thing into land and start the makings of a recovery and try and limit some of the damage on areas like the labour market?
Okay, maybe I'm just pessimistic because it's a Wednesday, but in terms of the like the things that create inflation locally in New Zealand, I think I understand the reasons why the Reserve Bank would absolutely be justified in making a monster cut to interest rates if they really wanted to, because it seems like they'd be at little risk of sparking something off. And so I just wonder, will a potential trade war, will escalating conflicts in Ukraine and the Middle East potentially derail the efforts of the Reserve Bank to lower interest rates to help our New Zealand economy? Because potentially we could be importing the inflation that we have slayed domestically, right?
Well, yeah. Look, exactly. Look, there are risks to inflation, and particularly tradables inflation, as you've said, from things like tariffs, for example, something we've all become experts in over the past month. I mean, tariffs are generally thought to be inflationary for the Reserve Bank. When the Reserve Bank comes to look at inflation, it matters, the sustainability of any sort of inflation shock, i.e., if we're getting a bunch of tradables inflation because the New Zealand dollar has fallen really rapidly in a short period of time, and look, there's some early signs of that happening, that is something that ordinarily the central bank would look through. It's not a sustained inflation shock, which brings me to the next point. unless you start to see inflation expectations drift up again and people start factoring in those higher tradable prices into their wage demands and prices more generally. That is the sort of stuff that the central bank would be worried about and would probably factor into its thinking on interest rates. So it kind of matters which one of those two things, and they're not binary, of course, but the share across those two areas you get. I think, if we're thinking about what the Reserve Bank might do today and maybe in the short term, like in the next meeting in February, the uncertainty about trade war and tariffs and not only, their impacts, but actually how much of the proposed tariffs see the light of day is too great to really factor into their thinking. So certainly for today, I would expect a pretty kind of steady as she goes, maybe a 50-point cut. And then, look, we're keeping quite an open mind about the future. I think that's what you saw from the US Federal Reserve as well, is to say, we know that a lot of the stuff's being talked about. We don't really have a lot of meat on the bones of some of those policies, though. So we'll keep an open mind. We adjust policy every few weeks. We'll just sort of see how we go.
Yeah. Once you try to see past 3 months, it's really murky right now. It's really difficult to understand which cross current will dominate and what is just an irrational fear. Like I look at the tariff situation, I can understand the case that it is tremendously inflationary for the US consumer, and ultimately that does ripple out throughout the world as well. At the same time, that's also, that's coming from the guy who wrote the book, The Art of the Deal. But
and look, the market narrative or perception of that is changing just so rapidly. I mean, even in the last sort of 24 to 48 hours, we've seen market perceptions flipped around kind of all the way to, hey, maybe we don't see the full extent of these tariffs, or some countries might avoid them altogether because of Trump's selection of the US Treasury Secretary, kind of regarded as a more moderate. Then Trump comes out and puts a tweet on his platform, and the whole thing changes around again, and market reaction unwinds that previous change. So it's just a moving feast at the moment, and it's very difficult to say anything too certain about the future. One thing I'll just add, though, is that it is not necessarily the case that trade wars, tariffs, automatically deliver you higher inflation, because let's not forget, New Zealand is a trading nation. We earn a lot of our income from exports. So trade gets hit, global growth gets hit. China in particular, our largest trading partner, takes a knock to its growth prospects. Well, that ultimately slows down economic growth in New Zealand, which is disinflationary. So there are things in the mix that are working actually in opposite directions. It's not really clear which one of those wins out, or what the net is either. So another reason to kind of maybe pull your guidance in a little bit, and just keep things tight until hopefully some of that fog clears, maybe in the new year. Yeah.
Is there actually a risk, especially given the labor market situation, where maybe the types of people that we would need to increase actual output in the economy have all left? Therefore, when the pressure comes on, there's no ability to turn up the labor dial. Does that kind of signal the risks of stagflation are high, where you have low economic growth and high prices for longer than they should be high for?
Yeah, look, maybe that sort of scenario you're outlining kind of raises the risk that the country's supply potential is lower than otherwise. So the amount of activity or economic growth we can sustain without generating inflation is lower. If our resourcing here, be it labor or otherwise, has reduced, or our productivity is lower than we would like, and that seems to be clear, then the economy might be able to only grow at hypothetically 2.5%, rather than sort of 3%, without prompting a central bank response. So I would say that the supply side of the economy was kind of one of the things that economists generally kind of got wrong through COVID. And so, there's every chance that could happen again. I think stagflation, from where we sit today, seems pretty unlikely. I mean, we've got the stag bit, we've got recessionary type conditions that are still, I would say, overall there. But we don't have the inflation that goes with it. At the moment, we seem to have moved on from that. In fact, the reason we've got the stag is because of inflation. We had an inflation problem, and as you said at the start, we had to slow the economy down to bring that back into line. So, yeah, what are we seeing today? I think we've had, what have we had today? 75 points worth of interest rate cuts, and we are starting to see the beginnings of an economic response to that in some of those interest rate sensitive areas. So I think we will see, maybe in the current quarter, maybe at the start of next year, the economy starts to creak back into gear again and grow, and then hopefully we'll get rid of the stag bit as well.
Yeah. So I'm looking at another graph here which talks about the periods of time that New Zealanders fix their mortgages for, which I think is really interesting and is very different to a lot of other mortgage markets. It looks like almost 93% of all borrowers will fix their mortgage for 2 years or less. We're very, very sensitive, aren't we, to changes in the OCR, because that flows through a lot more immediately. And do you think that that is somewhat responsible for the pace at which the Reserve Bank of New Zealand was able to bring the economy to its knees? The fact that a lot of borrowers were very exposed to the interest rate changes?
I think what we saw here, and you can see this, I guess, in the numbers and how they've played out, for example, compared to Australia, is it took a while for that traction, for those Reserve Bank rate hikes to feed through into mortgage rates, because at that time, people were relatively more hedged than they are now. Like 1 and 2 year terms were more popular. Mm-hmm. Even a bunch of people got on sort of 5 year terms when we saw interest rates really low through COVID. So it's taken a while for those rate hikes to kind of catch up with the mortgage belt. And we were quite vocal during that period about, well, we know that's happening. It's going to happen. It's going to involve obviously some cash flow impost, and it's going to take some time, and it did. And when it did come through, I think that effective mortgage rate, if you like, the average rate that people are actually paying, has only just really peaked kind of now, or maybe a month or so back. So,
yeah.
On the other side, as we go down, the transmission is going to be quicker, because people have really seen this easing cycle coming, and they've been shortening up the term of their borrowing in advance of that. I actually think this has been a really good story, because households have seen the cuts coming and shorten their debt, as I've said, even though it's cost them to do so, as you know, Darcy, to take on a 6 month or a 1 year terms cost you more than looking at 2, 3, 4 year terms, because of that downward sloping mortgage curve. But people have been prepared to do that, be strategic about it, pay more to benefit later, and we're going to see some of those benefits flow through relatively quickly as a result.
So borrowers are kind of banking on a steeper interest rate drop. Are borrowers correct? Are economists just slightly more conservative with their forecasts, or is there some truth in between?
People are short, no doubt. Like if you look at the last 2 months, I think 85% of all mortgage borrowers have been on terms of 1 year or less. So it's short, and it's getting shorter. I think just over half the book will roll or have a rate reset in the next 6 months. And that is about as high as we've seen since we have that data, which goes back to 2016. So tells you there's a bit of interest rate risk around. Before this, I worked in corporate risk management, right? And in a treasury setting, and they'd look at that and go, gee, that you're running some rate risk there, because no one knows really what interest rates are going to do with sort of perfect foresight, but you are exposed because people are short. So, I sort of think if we look at mortgage markets and the mortgage curve, there's probably some further declines to come in those short-term rates, because they haven't fully factored in the OCR easing cycle yet. The longer-term rates have. So, yeah, there's probably some further gains to come. But I guess the point you're making is, well, are they enough to justify paying a bit extra? And that decision very much goes kind of to risk preference and risk tolerance and so forth. I do probably think, though, that the time to think about terming out your mortgage and fixing and so forth is maybe not here yet, but it's probably a bit closer than what might be the general perception out there.
It should be, in my view anyway, about risk management more than anything else. Say this time next year, is it possible that we could be looking at fixed rate periods which all start with a 3? Or do you think that that will be rare? Do you think that it's more likely that we'll kind of normalize around that low fours? I'm talking about the fixed rates that people pay, not the OCR.
Yeah, look, so if you go back, and you're right, I mean, this is quite a common question is, well, can we expect the sorts of rates that we saw in 2020, 2021 again? What I would say to that is those rates were crisis settings. So unless, you think we're going into a crisis, the answer would be, well, pretty unlikely, but no one knows, right? No, I mean, these things come up now and then. No one foresaw the pandemic, and hence no one foresaw those low interest rates. So no one would want to sort of draw a line under them and say we're never going to see those things again, because chances are we'll get something come along at some stage. Who knows? But look, if you look at our official cash rate view and our general interest rate view, rates falling into the threes seem relatively unlikely. As I say, based on our numbers that we're seeing at the moment, but there's always potential for shocks to come along. I mean, that's probably relates to your point about risk. Whatever your view of interest rates, we know that they are wildly uncertain, and economists get it wrong. So be aware of the risk that you're running if you're thinking of going in an entirely short kind of strategy or whatever it is. It just sort of pays to think about that.
Yeah. And so is it really true to say that bad news equals good news when it comes to your interest rate?
We have tended to see interest rates come down at a faster pace than they generally go up because things come along. It's generally been bad news in the last 5 to 10 years, as you suggest, rather than good news, and that's prompted that sharp interest rate response. So, look, under the scenario you mentioned, I kind of feel like we'd have bigger fish to fry there in that sort of scenario than thinking about our interest rates. But I guess it just highlights the point, right, in that people tend to underplay the uncertainty that surrounds the outlook. You've sort of got to think about when it comes to your risk. And at the moment, it does look and feel like the global picture is shrouded in a lot more uncertainty. A lot more things can potentially go wrong than go right.
Yeah. Do you think the Reserve Bank of New Zealand over the past 4 years have done a good job?
I think they've had a tough run. And look, you're seeing that in some of their commentary. We were saying earlier in the year that there was probably a case to cut interest rates or to get started on rate cuts earlier than what we ultimately saw. So that's there. But where we are now, I think it's probably the right approach. I think, or the right bias, because if the Reserve Bank kept the OCR higher for longer on the idea that, look, the inflation risks that we saw going back 6 to 12 months were proving quite sticky and persistent. The quid pro quo of that was always that, okay, once inflation is back under control, well, there's plenty of room to cut the OCR aggressively. And that's what we're seeing. So, I think where we are now, we had a 50-point cut in last meeting. Maybe we get another one today. We think that's probably the right approach. We've ended up in the right spot.
Just changing tack a little bit more here, thinking about the man in orange. Let's talk about Donald Trump just briefly here. We're seeing quite a significant strengthening in the US dollar. Markets are starting to go bananas-ish. Definitely seeing a risk on sentiment with the S&P 500, for example. Farmers are going to benefit a lot. Like exporters are going to do pretty well, right? But in terms of imported goods, oil being one of them, the price of fuel, are we expecting those costs to go up?
Yeah, I mean, you've outlined it pretty well. What I would say, just going back, is the thing about currency markets, FX markets, is that they incorporate, they're highly liquid. They incorporate essentially everything we know now in today's price. So we've already seen quite a drop in the Kiwi dollar against the US. It's pretty hard to know kind of what exactly is implied or baked into that number. So it's not necessarily the case that it sort of stays soft, lower, falling forever, because things are going to come along, as we saw yesterday, that are going to throw the thing around a lot, right? So the point being, some of those expectations about a Trump presidency are already baked in, so it's not necessarily the case that the thing keeps weakening from here. And then, look, lower New Zealand dollar, all else being equal, increases the cost of imports and does help out the exporting sector. We're seeing parts of that exporting sector, if I think about dairy, kiwi fruit, horticulture in particular, experiencing or likely to experience some pretty decent looking returns over the coming 12 months. So look, where we are in the cycle as well, you would probably, independent of what's going on in the US, expect a low New Zealand dollar. We've been in recession. We've got an economy that's underperformed most of our peers. And when you see that, you typically see the Kiwi dollar quite weak, and that helps us kind of export our way out of recession. So that's an encouraging development.
Would you suggest that it will be definitely a export-led recovery?
From where we're sitting at the moment, those sectors I mentioned, dairy, kiwi fruit, horticulture more generally, are certainly floating to the top of any sort of sectoral or analysis you might want to do. The other areas you'd probably look at are some of those more interest rate sensitive sectors as well, right? Because they've been the most beaten up through this interest rate driven recession. So you would expect, as rates come down again, that those sectors to start to thaw out. And indeed, we're seeing that a little bit in things like retail spending. It's still really weak, but it's stopped falling. We're seeing in some of our internal numbers a bit more of a propensity to spend on discretionary type stuff, all that kind of fun stuff that's been parked for 2 years. So I think there's some creaking there. The same in, consents. Residential construction has been at the vanguard of this recession as well. Also an interest rate sensitive sector. We're starting to see consents kind of stabilize, maybe lift a little bit, and maybe the same for housing. So all of those areas I think will be the ones to watch, as we go through into early next year. And in some cases you kind of need retail spending to lift, otherwise you're not going to get a recovery. It's 2/3 of the economy, so you're not going to experience much of a recovery without people starting to open the wallet and splash the credit card around a little bit more than they have been, which is basically being not at all.
Right. And these like recoveries take time. When you're crushing the economy, that's reasonably easy to do. But when you're trying to rebuild it in an orderly fashion, that seems to have delays and isn't never perfect. But just like the labor market, where we're losing a lot of people overseas, we're also losing the speed at which we're improving the amount of new housing stock. So do you see that in a similar way that businesses will still hit problems when they try to expand because of lack of labor? Do you see that with immigration, when and if it does pick up again, will we see a significant uptick in house prices because of renewed demand?
If we continue to build at the low rates we have been over the last couple of years, as you said, then all else being equal, there's going to be some pressure on the price of housing. And there was pressure on those areas, of course. We saw a big spike in rents. We saw some parts of the housing market, house prices lift as we got that big population boom and as we've built fewer houses. I think from where we're sitting just at the moment, and look, these sort of computations are always difficult, right? Because there's so many spinning plates and balls in the air you have to juggle to kind of come out with the net implication. But look, consents are stabilizing. I think we've seen confidence in the building industry lift. You can see that in the ANZ business survey and other areas. Our expectation is that cycle starts to turn into the new year. So you'd start to see building activity lift a little bit. At the same time, population growth has come down really rapidly from above 3%, really strong for New Zealand, to probably where we are now in real time, sub 1%. So actually, I think the combination of all of that will take a bit of pressure off housing demand. So it doesn't necessarily mean house prices fall. What I think it means is, as the housing market cycle turns with lower interest rates, it doesn't turn as aggressively, or you don't see house prices rise as rapidly as you might otherwise. So I like to sort of compare to what we saw, say, in 2020, 2021, where we went into lockdown and mortgage rates were slashed in an environment where we were really short of houses. It was kind of tinderbox conditions for house prices, and we all know what happened. It's not the same now, I don't think. We've definitely seen housing construction slow down a lot, but we've also seen population growth come down. So I think that the net of all of that means there's less pressure. There's still pressure, but less than what we might have thought, a year or so ago. Okay.
And so lastly, the question probably more around migration, like net migration coming into New Zealand or out, but also internally. So my kind of understanding of how this works is that when net migration is high, like there's more people coming into New Zealand than leaving, typically Auckland is the biggest beneficiary of those new people. The Aucklanders might move to the regions, and the regions, when all the Aucklanders show up, they take off as well, and they go further out, and it seems to kind of like a ripples in a pond. What's happening, or what do you see happening in the next 12 months with those ripples in our pond? Do you see the internal migration patterns changing as the economic cycle kind of enters into a new phase?
It's a really interesting area, internal versus international migration. Yeah, you're right. First of all, international migration overwhelmingly comes into Auckland. Over half of the raw number ends up in Auckland. So we've seen Auckland outperform in overall population growth stakes for 2 years. Internally, what I think we're seeing is it's almost the reverse of what you're seeing in kind of other countries, which is this idea of urbanization, people coming from the country into the cities, or in your developing countries, where people are this flee the cities vibe, where if you drill down and look at Auckland City, Wellington City, even Christchurch City, people are leaving, they're going out to some of those fringe suburbs. And I think the reason for that is housing costs. It's become too expensive in some of those areas for particularly young people to be able to afford a house, and so you sort of move out to the fringes. Maybe if you can work from home or whatever, that helps. So that's been the trend now for a wee while. I think there's probably a misconception out there that it was the whole work from anywhere thing in the pandemic that caused people to leave the cities. It's actually been happening for a wee while. It is slowing though. Basically, to get to the number of your question, I think it continues. I think this flee the city vibe is got legs. It will continue to see it occur, but because house prices have converged a bit, right? So Auckland, relatively speaking, is less expensive compared to, say, Christchurch than it was. The push factor is less, in the same way that Christchurch prices are not as relatively cheap as they were, and so you're not seeing as many people move out to some of those areas. So it's a trend I think has got legs, and we'll see further movements in those internal migration out, generally kind of south and to fringe areas, but we're seeing the rates at which they're doing that just slow up a little.
If New Zealand experienced sharp migration outflows and then the internal migration or displacement stopped or even reversed, could that more dramatically affect property prices in these regions relative to Auckland?
Yeah, hypothetically. I mean, the other thing we probably haven't talked about, I think we've talked about kind of the demand side, which is where are the people going. Yeah. There's also the supply side, which is what's getting built. And so if you look at those numbers, kind of construction per capita in the regions, for example, the one that stands out is Canterbury, Otago and Auckland have built relatively well as well. And those supply side developments can certainly trump or accommodate demand changes. So for example, Auckland townhouses have kind of gone nuts in the last few years. There's been this sort of infill housing, a lot of construction, and so I think that's probably part of the reason that Auckland house prices have tended to underperform the rest of the country for a couple of years now. They've either fallen by more or gone up by less than other parts of the country. So I think that supply side's been really important. Canterbury, again, has had the earthquake, but has also continued to build really strongly for 10 years and has been part of the reason that houses are more affordable in Canterbury as well. So, and you go down to Otago, it's just construction boom. Not boom, but they have clearly not experienced the same sort of slowdown that other areas have.
Okay. Yeah, like this time next year, what do you think it looks like, though, in terms of, say, let's just pick something simple. Let's say for a 1-year fixed rate mortgage, which currently on the BNZ website, I think it's 5.79% for a 1-year mortgage. This time next year, what would you say to that? Would you say, Mike, that we're looking at something maybe even 1% less than that, or even more?
Yeah, look, mate, I would say lower. Look, I think as you outlined it in your preamble, the uncertainties are so massive that oftentimes getting the direction right is half of the challenge. So, yeah, if we're right and where the official cash rate's going, then that 1-year rate will be a little bit lower. I don't think a whole lot lower, really, because this time next year, it's hard to know what sort of conditions that we're going to be in. We're probably the interest rate normalization cycle would have continued and be impacting on mortgage rates, but I'm sure there will be something else uncertain that would have crept up that no one expected that will, or whoever your guest is at that time will be talking about. So
that's right. There'll be some other story. What about house prices? Do you see house prices just generally across New Zealand on average? Do you see them significantly higher, about the same, or even lower?
I think about an average sort of cycle. I mean, that's what I've been talking and thinking about forecasting for a wee while now. We see the cycle turning. There's some evidence to say that that's happening. Turnover's starting to pick up. All the softer indicators that you want to look at around housing are starting to sort of point upwards. But I think there's some good reasons not to expect a really strong, aggressive house price cycle like you would have seen in the past. We've pegged about a 7% lift, kind of on average across the country for 2025. I've just been looking at that recently. Don't really see any reason to change it. Obviously, the interest rate cycle is a big consideration there, but it's one thing we know about house price forecasting. Again, it's you're doing well if you're getting the direction right. So
that's right.
We'll see. We'll check in and see how I've gone.
Yeah. So we're going to say a 7% average growth rate in terms of property prices. We're going to see interest rates probably a little bit more than 1% off of what the current 1-year fixed rate would be. Keeping in mind, of course, there's a cash rate announcement today, which will probably reset that yet again. In terms of, and then lastly, the immigration story. Do you see the net immigration story changing, say, this time next year, or are we going to see much of a similar sort of pattern where we're losing a lot of natural-born Kiwis, and we're bringing in a lot more other people?
Look, I think what we typically see and what we have seen is that kind of migrants follow the opportunities, and so there are not a lot of job opportunities in New Zealand at the moment. Certainly a lot less than there were, as we talked about right at the start. And so we would see net migration still positive, but kind of holding around the current annualized rate of, say, 30,000 people a year. That's a lot lower than it was, but I don't think it turns negative. I also don't think it really takes off either, given what we're expecting and forecasting for the labour market, which is that weakness has probably got at least another 6 months to come through. So, I would expect us to sort of bobble around the lows in that net migration cycle.
Okay.
Call it 30 to 40,000 people, annualized per year. Not negative, but not strong either.
Okay. Cool. If someone like myself was curious, and I want to learn more about what the relevant things are that might affect us here in New Zealand, what are some of those things that you personally would be watching right now overseas?
Yeah, so when it comes to overseas, I think number one still for us has to be what's going on in China, because that's still our largest trading partner. Sometimes kind of hard. We don't get as much information about what's going on, say, in the Chinese economy as we do in the US, which is still an important trading partner, but not as much. So, that is an area for me that I'm always looking at and trying to understand. I think what we're seeing there just recently is some slightly more encouraging signs around kind of spending appetites and the prognosis for the economy in China's housing market. So, that I think has to be number one when it comes to New Zealand's economy, given our trade exposures. And then, look, we can't avoid the fact that we've got an incoming president in the US that's going to change up a bunch of the US kind of economic landscape, and the US as well. I mean, we haven't discussed this as much. Is actually an increasing source of export demand for New Zealand. It's leapfrogged Australia just in the last 3 years, and is now our second largest trading partner for exports.
Pretty cool.
Yeah, that's been kind of a good story as well, because that's been a strong part of the global economy over the past year or so. The US economy has kind of blown everyone's expectations away. And so to have more export going there has helped us, but it obviously brings risk in an environment where we're talking about tariffs. So that would probably be the other one. And then, of course, you've got all those kind of troublesome risk events, or possible sources of risk happening all the time. So,
have a look at the recovering story in China, have a look at the continuing strength of the US economy, and then for good measure, consider the risks of war expanding effectively is what you're not saying, but I think you're saying. Would that be fair to say?
Well, yeah, I mean, look, things, there's things happening all the time, risk events, whether it's the conflict in the Middle East or whatever have you.
Sure.
And they're unforecastable, right? I mean, no one knows what's going to happen there and what the implications are.
Alien disclosure. All right. Well, that's really awesome. So thank you for that conversation and for the summary in terms of what to expect next year. I think it's not true to say that, hey, it's all bad, that, hey, pack up sticks and take off overseas. Mm-hmm. I think this is just the natural part of any cycle where you go through up times and down times and sideways times. Feels kind of more like what you're painting the picture of here is a sideways time, not necessarily a continuation of a decline or even a sharp recovery, but much more of a sideways chop until things kind of normalize. Would that be fair to say?
Yeah, I think it's a really awkward part of the cycle, actually, because there's two things happening, I think. One is we will be seeing, and we are seeing, some of the scarring or hangover effects from what has been a really nasty and big and long recession, right? Yeah. We're seeing rising unemployment. We're seeing corporate insolvencies, things like that. And those trends have probably got another 6 or 12 months to run. But at the same time, you are seeing signs that the economy is starting to just creak back into gear. And you're going to see people like me out in the media kind of talking about growth as well. So I think you're going to have both of those happening at the same time, as you kind of do when the cycle's turning, you get those late cycle impacts. So I think it's going to be quite a difficult time to sort of read in terms of what's going on, because you've got both of those things happening at once. But yeah, look, as we go through, and by the time you get your guest on this time next year, hopefully we'd be more into that upswing part of the cycle, certainly.
Yes. Awesome. Thank you very much, Mike, for the conversation. Where can people go to follow you or to follow some of the output that you guys create?
Yeah, so you can find most of our research on the BNZ website. We've got a sort of research hub there, and you can sort of access everything we put out on there. Or if you can't find it, just drop me an email, and we'll find a way and get you signed up.
Yeah, I'll put a few links in the show notes as well. Thanks again, Mike. You enjoy the rest of your week.
Thanks, Darcy. Same to you. Great to chat.
Cheers. Thank you.